So let me, instead of talking about the specifics, let me segue a bit into the more generalized idea of venture capital, angel investing, and private equity. First of all, I think it'd be good to describe what the differences are amongst those three, but then also talk about what role does that play? Why is that important? I mean, why you guys you're in business, so clearly you're doing this as a business venture, but this is also it fills a role in the economy. It fills an actual need. So start by talking about what the three different types of funding are.
Yeah, so you mentioned those 3 areas, but even before angels get involved, obviously as a founder of the business, usually the founders put some money beyond the sweat and tears, and sometimes blood that's put in. You put a little bit of money in. Some friends and family, some people call it friends, family, and fools. But then after all of that is
friends,
done,
family, and credit cards.
Right. Yeah.
Friends, family, and golfing buddies.
Yeah,
it's a lot of terms.
Yeah. But after that comes angels. Angels are typically the first outside money that comes in. Usually that's in sort of smaller amounts. Again, it's from a couple $100,000 up to $1 million. In the recent surveys that Larry and I have been looking at, the average for an average deal that angels have invested in, it's about $450,000.
That would be an individual angel would.
No, that's sort of combined, sort of a deal of $450,000. So as an individual angel, people usually invest anywhere from $10,000, $15,000. It's usually $25,000 as a minimum to up to a couple $100,000. And then there's super angels who can invest a few $1 million. But again, the angels typically play up to about $1 million within a company to start getting going. And it could be a pre-revenue company, so it's hasn't yet sold a product.
But it's developing products.
It's developing the products, maybe doing some additional R&D. It's pushing forward. It needs to do additional sales and marketing. And then to the next step of capital is venture capital, which these are firms which have raised significant funds, anywhere from $10, $20 million up to $1 billion type funds. And it depends upon how early they play in the stage, but these are usually companies that are willing to invest anywhere between $1 to $5 million in a company.
And these are established companies that that's their business, right? The venture capital companies, that is really what they do. They try to find promising startups, put some money in, and hope to reap big returns later down the road, right?
Yeah, and these venture firms raise money. The way they get their money, they get some money from very wealthy individuals, but most of their money comes from institutions, public pension funds and other large endowments. And so they're tasked with bringing in, having all this money, and they have to find the right opportunities to invest that money. In the end, they need to make money for their investor base. So they want to make sure that the opportunities are large. So most of these, investment firms, VC firms, are looking for businesses that could be $100 million and larger. For angels, the business doesn't need to be as large because you're putting in less money.
But they're still looking for some fairly substantial return, like
Correct.
3, 4 times, maybe 10 times what the money is.
You always try to shoot higher because it's always going to get lower. So the objective is hopefully you can make 10 times on your money. There's always sort of analogy of looking at if you have a diversified portfolio and you make 10 investments, it's very likely that 3 of them will go bankrupt. They'll be worth 0. Usually the one home run usually returns 90% of your entire portfolio. And then the rest inside the middle, some are singles and doubles, predominantly, maybe you get a triple. But it's really that 1 out of the 10 which is going to bring you almost all of the money. And it's really very few companies that succeed and ever become an IPO. So as angels, as venture capitalists, everyone's trying to look usually for an M&A transaction where folks have
M&A,
money.
mergers and acquisitions.
Correct,
right?
correct.
So Larry, what about now? I mean, we're in tough economic times. We may still be in a recession. We might just be coming out, depends on who you talk to. So is it more important now or is it harder now? What does our current economic environment do to the angel investing and the startup environment?
Yeah, that's a tough area. It is both more important and it is more difficult. There was about a 25% drop in angel investing from 2008 to 2009.
That's nationwide?
Yeah, so there was a decrease. There was also a decrease in venture investing throughout the recession. So the whole class has suffered. However, the good news is there are more and more angel groups. And they're actually, over the last several years, they've been increasing the number of investments they've made. They're made last year, I think it was about 55,000 investments. in companies, and that totaled about $19 billion.
Billion.
Yes.
Billion.
And the VCs invest about $28 billion. But they do that $28 billion in only about 4,000 companies. So they're investing on average about $7 million in each transaction. The VCs or the angels are investing in much smaller size investments, as Michael said last year, or 2 years ago, it averaged about 450,000.
And that ends up being many more seeds.
So
in the
many
economy.
more seeds are being planted, and so those are critical. And over time, what has happened is the VCs, as I said, the average investment now is $7 million, which means they're not investing in a lot of the startups. They're not investing in a lot of the seed stage businesses. So if you're an entrepreneur trying to get your business going, there used to be a time where venture capital might have been an option, even at the early stages, just getting started or $1 million in revenues. That's very difficult now. So the angels have stepped up and have started to fill that gap and making investments. Just in the last decade, we've gone from 100 angel groups as part of the ACA to I think 300. So it's a near tripling of active angel groups out there investing.
Yeah, just so people know, the ACA stands for the Angel Capital Association, which is a national association of angel groups, which didn't exist too long ago, but now we have over 350 groups across the U.S.
Yeah, and Cornerstone is one of those groups
Correct.
in the
That's
association.
correct.
Right.
Right. So it's interesting. I want to come back to something that either one of you can answer. But Larry, you just talked about the angel investors stepping up to fill the void that's been left by the venture capital
Right.
stepping back. Now, venture capitalists are, I would believe, pretty good at measuring risk. And if they're stepping back and the angel investors are stepping in, are they really undertaking more risk? And do angel investors as a whole know what they're doing, or are they just stepping in because no one else is there?
Well, I'll take one piece of it, and Larry may have a different perspective. But one of the reasons that the VCs are investing larger amounts of money and not filling this void for the earlier stage side is one, because in the heady times of things were going gangbusters over the last few years up until sort of the end of 2007. You had a lot of very large funds. You had multi-billion-dollar funds, and it was
These are venture capital funds.
venture capital
right?
funds, yeah, that were billions of dollars. And because they became larger and larger, the only way that you could deploy that much money was to be investing much larger deals. And so no longer could you be making $1 million or $2 million with a $1 billion fund. You'd have to be looking at how can I make a $10, $15, $50 million investment. And so that's one reason
there are
they
fewer of those, right? Those aren't around as much
Correct.
as the $1 million deals, right?
Correct.
Yeah, I mean, the other statistic is if you look over long periods of time, it is clear that the early stage investment class outperforms all others. The research by
In terms of
Hayward and
overall
Associates.
returns?
Yes, in terms of returns. Now, it is more risky, absolutely. The earlier in the stage of a company you go, the more chances before it grows up that you have for failure. It's just the nature of the game. But it also provides potential for greater returns. So what's important is the risk-return ratio. And that gets down to a lot of things. It gets down to what kind of diligence you do. It gets down to valuations. How much you pay for a company, for example, what kind of share you get in that company. It depends on what types of companies you choose to invest in. And what's interesting right now is it may actually be a reduced risk profile for early stage investing because there's less money chasing those deals, which suppresses the price that people will pay. It's a supply-demand phenomenon, simply. So there's less demand among the VCs for those early stage deals, which means that those that do demand that, the angels in this case, can be a little bit more choosy.
So the quality of the deal is going to be better because...
Well, there may be the universe of deals may not change, right? But the angel investor may have more to choose from. In other words, that angel investor may not be competing with a venture capital firm on a specific deal.
And I would say,